Welcome, new examiners, to our deep dive into bank earnings analysis.
That's right.
It's a pretty crucial skill for anyone starting out in bank regulation. It's like learning to read the vital signs of a bank's financial health. Today, we're going to be talking about the earnings analysis trail. It's a framework described in the earnings.pdf document.
Yeah, it's really like a treasure map. It leads you through a bank's income statement, and it can help uncover some hidden gems and potential risks, too.
And why is earnings analysis so important from a regulator's point of view?
Well, you got it, because earnings are a bank's first line of defense against all the risks that are inherent in this business. So we need to determine if a bank can handle losses, if they can keep their capital strong, and if they can stay competitive over time.
So we're like financial detectives, trying to figure out what the numbers are telling us about a bank's health. I've heard that there's a difference between core earnings and non-recurring items. How do those factor into our investigation?
Oh, that's a great question. Think of core earnings as the regular business activities of a bank, their bread and butter, and then non-recurring items. Those are events that could really skew the picture. Like, say if a bank sells a large part of its securities portfolio, not as part of their normal investment strategy, that would be a one-time windfall, and it could really inflate the earnings for that year.
It's like judging a restaurant's success on a one-night catering gig, not their regular dinner service. So how do we account for these non-recurring items when analyzing earnings?
Well, we adjust for those outliers because
Okay.
we really want to compare apples to apples. So we want to see how the bank is performing on its regular day-to-day activities.
We need a clear picture, not a distorted one. Now, I understand there are two main approaches to earnings analysis: level analysis and trend analysis.
You got it.
Can you walk us through those?
Absolutely. Level analysis is like taking a snapshot of the bank's financial health at a specific time. We would look at ratios like return on assets, ROA, or net interest margin, NIM, just to get a sense of how the bank is performing right now. Trend analysis, that's examining how those ratios have moved over time, typically the past 5 years. That can help us identify any warning signs or any positive developments early on.
So level analysis is the snapshot, and trend analysis is like watching a time-lapse video. And this is where that earnings analysis trail comes in, right?
Exactly.
Can you tell me about that?
The earnings analysis trail, that's our roadmap through the bank's income statement. It highlights the key areas we need to scrutinize.
Okay, let's hit the trail. What's our first stop?
First up is net interest income. This is usually the bank's biggest source of revenue. It represents the difference between the interest they earn on loans and the interest they pay out on deposits. But a high net interest income ratio isn't always a good thing.
I thought more income was always better.
Well, it could mean that the bank is taking on too much risk to get those high returns. They could be invested in high-yield loans that carry a higher risk of default.
So it's a classic risk-reward trade-off. What are some other red flags examiners should be looking for?
Well, examiners need to understand the context, the bank's lending strategy, and the overall economic environment. Are they lending to riskier borrowers? Are they concentrating their loans in one particular industry or area that could be more vulnerable?
It's not just about the number, but the story behind it. Okay, so what's next?
Next is non-interest income. This is where things get a little more diverse. Includes things like fees for services, trust department income, even gains from trading activities.
So everything that's not directly related to making loans, what are some key considerations here?
Well, the key is to determine whether these sources of income are sustainable and part of the bank's core business, or are they just one-time events? For instance, if a bank sells a branch building for a profit, that's a one-time gain, and it shouldn't be a factor in our assessment of their ongoing earnings power.
So if a bank relies on income that could dry up tomorrow, that's a potential problem. It's about understanding the stability and reliability of those sources of income. Then, of course, there are expenses.
Nobody's favorite topic, but very important: non-interest expenses or overhead. We look at how much they are spending to generate their income. We pay close attention to large expenses like salaries or management fees and occupancy costs.
So we're looking for anything that seems excessive, especially for banks that are showing signs of financial stress. What are some specific things examiners should watch out for?
We look at the trends. Are expenses increasing faster than revenue? Are there any unusual spikes in certain expense categories? We also compare the bank's expenses to its peers. Is it spending a lot more on salaries than other banks of a similar size?
So it's another piece of the puzzle.
Okay.
What's next on our earnings analysis adventure?
Next is provision for loan and lease losses, or PLL. This is where things can get technical, but it's essential to understanding a bank's risk management practices.
I've also heard the term ALL. or allowance for loan and lease losses. Is that connected?
Yes, think of the ALL as like a rainy day fund that banks set aside to cover losses on their loans. And the PLL is the amount they add to that fund every period.
So if a bank anticipates that more of its loans might go bad, they would increase their PLLL.
Right, and as examiners, we want to know if the bank's ALLs is adequate. Is it enough to cover potential losses? We would consider factors like the bank's loan portfolio, the overall economic climate, and any changes in loan quality.
It's about aligning the size of the rainy day fund with the potential severity of the storm. Okay, what's our last stop?
Our last stop is realized gains losses on securities. Here we're distinguishing between banks that actively trade securities as part of their core operations and those that are selling off assets for other reasons, like restructuring their portfolio.
So if a bank is constantly buying and selling securities for profit, we factor that into our overall assessment. But if those sales are just one-time events, then we might need to adjust those gains or losses.
Right, we want to see how the bank is doing on its regular business activities, not one-time gains or losses.
All right, we've now walked the earnings analysis trail and have a better sense of the key areas to examine within a bank's income statement.
We've laid the groundwork, but there's so much more to explore.
Well, stay tuned, listeners. We'll be right back to dive deeper into the world of ratio analysis and earnings quality.
That's right.
We're back and ready to continue our journey down the earnings analysis trail. We've seen the landmarks. Now let's dig into some tools we can use to understand those financial statements.
It's time to break out that magnifying glass and look at some key ratios that can tell us a lot about a bank's performance.
Okay, I'm ready. What's our first clue?
Let's start with a classic, the return on assets, or ROA. It's a simple but powerful measure of how well a bank is using its assets to generate profit.
Oh yeah, ROA. I remember learning about that one in school. You divide net income by total assets.
That's right. But there's more to it than meets the eye. While a high ROA is generally good, it doesn't always tell the whole story. A bank can get a high ROA by taking on a lot of risk.
So it's like a high wire act. Impressive, but potentially dangerous. What are some signs that a high ROA might be a problem?
Examiners should look for rapid growth in assets, especially if it's concentrated in one sector or geographic area. Are they growing too fast, maybe fueled by risky investments? We also look at the quality of those assets. Are they making loans to riskier borrowers? Are they investing in things that would be hard to sell if market conditions went bad?
So context is everything. It's not just the number, but what's driving that number.
Right. Another ratio is the net interest margin, or IN for short. It measures the difference between what a bank earns on loans and what it pays on deposits.
So a higher IN means the bank is doing a good job at managing interest rate risk.
Exactly. A wider NIM suggests the bank is earning more on loans relative to what they're paying, but a declining NIM could be a sign of competition or rising deposit costs.
We need to look at the trends.
Right.
Are there other ratios that are important?
Absolutely. We look at things like the efficiency ratio, which measures overhead costs as a percentage of revenue. A lower efficiency ratio means the bank is controlling its expenses well.
So it's about finding that sweet spot between revenue and cost. What about ratios that help us understand a bank's risk?
Well, we look at the loan-to-deposit ratio, which tells us how much of the bank's deposits are funding loans. A higher ratio might mean the bank is more vulnerable to a downturn.
It's like walking a tightrope.
Exactly.
You mentioned earnings quality earlier. What does that mean?
Earnings quality is about understanding how reliable a bank's profits are. We look beyond just the numbers. We want to know if the earnings are a result of good business or accounting gimmicks.
So a bank might boost their earnings temporarily, but those strategies could backfire.
Exactly. That's why we focus so much on earnings quality. We want to make sure a bank's profits are coming from good sources.
It's like building a house on a solid foundation.
Yeah, that's a great way to put it. Now let's talk about something that can complicate earnings analysis. Extraordinary items. Those unusual and infrequent events.
The one-offs that can make things difficult.
Right.
Can you give me an example?
Sure. Imagine a bank sells a large building. That would be an extraordinary item because it's not part of their normal business.
So we need to adjust for these to get a clear picture.
Right. We are trying to separate the signal from the noise. We also need to be aware of accounting changes.
Oh yeah, those accounting rules, they seem to always be changing.
New accounting standards can have a big impact on earnings, so we have to keep that in mind.
It sounds like we need to really understand those accounting principles.
Definitely. It's about putting the numbers into perspective.
Now, before we move on, I want to touch on dividends.
Ah, yes, dividends. The portion of earnings paid out to shareholders.
Like a reward for the investors. How do dividends factor into a bank's financial health?
If a bank pays out a lot of its earnings as dividends, it could mean they are putting short-term rewards ahead of long-term stability.
So it's a balancing act. We want banks to reward their investors, but not at the expense of the bank's future.
Right. We look at their capital levels, their earnings history, and their future capital needs.
All about sustainability.
No. One area we are really careful with is undercapitalized banks.
I bet dividends are a no-no in those situations.
Exactly. We strongly discourage dividends if the bank's capital is too low.
It's about protecting the bank. This has been a great journey.
It's just the beginning. Earnings analysis is a process of learning and questioning.
Well said. And we're back for our final look at bank earnings analysis.
And we're going to zoom out a little to look at the FDIC's safety and soundness standards for earnings.
So this is the regulatory framework.
Yeah, these standards give banks a way to evaluate their earnings and to make sure they have enough capital and reserves.
So it's about more than just the numbers. It's about a healthy financial position.
Exactly.
What are some things examiners should be looking for when checking if a bank is following these standards?
Well, first, we want to see that management is comparing their earnings trends, both to their own history and to their peers.
Like checking the rearview mirror and looking ahead.
That's a good way to put it. We also want to see that they are evaluating if their earnings are adequate, given the bank's size and risk.
So a small bank doesn't need the same level of earnings as a large bank.
Exactly.
Are there other areas that examiners focus on?
We look at the source of earnings, the volatility and the sustainability. We want to make sure those profits are coming from reliable sources.
Not just a one-time thing.
Right. And most importantly, we want to see that management is taking steps to ensure earnings are enough to maintain their capital.
So earnings need to be strong enough
Mm.
to support growth and absorb losses.
Exactly. If earnings aren't meeting these requirements, that's a big red flag.
These FDIC standards seem like a really helpful resource.
They are. They give us a common language for understanding earnings.
This has been a really informative session.
I hope it's been helpful for our new examiners out there.
Remember, earnings analysis is an ongoing process. Keep learning and keep asking questions.
Those financial statements have a lot of information in them if you know how to find it.
So good luck out there, new examiners.
Let the earnings analysis trail be your guide. You've got this.
And to all our listeners, thanks for joining us, and keep diving deep